Good morning, everyone. Thank you so much for joining us on this Saturday morning. We are here to begin our webinar on navigating the private credit space, unlocking opportunities in the fixed income category. I'd like to take this opportunity now to begin this webinar and welcome our first guest expert. We've got with us Vaibhav Porwal. Vaibhav is the co-founder at Deserve. He leads investment management at Deserve. In his previous role, Vaibhav was part of the core founding team at IIFL Wealth, now known as 361. He has managed over 20,000 crore of assets for family offices and HNIs. In fact, serving as part of the investment committee for some of the large family offices. So thank you so much, Vaibhav, for joining us today morning.
Thanks, Hardik. Good morning, everyone.
Weber, first of all, for the benefit of the wider audience, we would like to begin with the purpose of having this webinar, this deep dive on private credit space. You want to take them through the requirement, the genesis, why we thought of this topic for this Saturday?
Yeah, thanks, Hardik. And before we dive into why we took time, let's understand the genesis of private credit. Why private credit started attracting a lot of attention from investors. So private credit is essentially lending money to private companies. So transactions where banks are not participating and borrowers are looking at private sources of capital. And over time, investors have started allocating significant part of their capital to this asset class. Back in the days, institutional investors would typically participate in these asset classes because these asset classes came with low liquidity and high returns, and access to these transactions was limited. But now there are multiple AIFs and funds which are offering these transactions to investors, individual investors also, as a result of which there is significant amount of curiosity around this asset class. And we thought it will be a good time to have an interaction around why this asset class makes sense for the investors and what are the various nuances that investors need to be aware of this asset class. Globally, this asset class is much bigger or equal as large as private equity. But in India, this asset class has just started gaining some traction. And investors are quite intrigued and interested to participate in this asset class. So that's why we thought it will be useful to have an interaction around this asset class.
Great, Vaibhav. So it fits in part of the fixed income portfolio, and there is increasing interest given this is an increasingly growing asset category. And with that, I will now introduce our guest expert on this webinar, Mr. Neeraj Karya. Hi, Neeraj. Neeraj is the CEO of Kotak Private Credit Fund, one of the largest funds in the private credit space in the country today. Previously, he has spent 5 years in KKR in the same role, managing private credit assets. Prior to that, he was leading large conglomerate and industrial verticals in investment banking at Kotak. In his experience, he's deployed over $500 million and returned the capital to investors. So, great pedigree, great background. Welcome, Neeraj, for taking time to educate our audience on this asset category.
Good morning. Good morning, Hardik. Good morning, Vaibhav. Good morning, everyone. Thank you for taking time on Saturday morning, and thank you for having me on the panel.
Great, Neeraj. Neeraj, since you're the expert on this category, I think we'll begin with what really is private credit. The curiosities around corporate borrowing through traditional channels like banks, NBFCs, mutual funds, vis-a-vis funds and other avenues to sort of source capital from has been significantly high over the last few years. So, you want to take them through the landscape of how corporates borrow, where does really private credit fit in, and more specifically, performing credit within private credit fits in?
Sure. So, if you look at the market, why does private credit actually exist? If you look at globally, all central banks are effectively forcing banks to give money only for working capital or regular capex needs of companies. And central banks want banks to be, for choice of better word, dumb lenders. And I'm sorry I'm saying this, but the reality is that it needs to be very simple lending. It doesn't need to be highly underwritten. It needs to be a simple structure, money coming back on time, right? that is where you see all the banks are being forced to lend, right? And it's the same phenomenon even in the Indian market. But for a company, especially for growing companies, the need is not just for simple capital. The need for capital is across the board, whether it is equity, which is highest risk, or some things that the banks cannot do. For example, longer duration type of structures, but something unique or customized solutions which banks cannot provide. Right? So effectively, alternate credit or performing credit or private credit exists because banks cannot fill this need. Historically, in India, some part of this need has been filled by NBFCs, and NBFCs have gone from about 15% of the total financial sector to about 25% of the financial sector today. And that is a significant increase. But there is a significant regulatory oversight even for NBFCs by RBI. And they are also being asked to simplify their structures, do more granular loans, don't do big loans. So the need still exists for customized solutions and for a little bit different type of risk than what banks or NBFCs can take. And that is effectively why private credit exists globally. As Weber very rightly said, globally it is a very large pool of capital. In India, this pool of capital is just starting off. But it is not that the borrowers in India were not borrowing under private credit before. They were borrowing it, but the money used to come either from foreign banks or foreign funds before, which was extremely expensive. This is in the first time in my career that I've seen real growth in private credit. In the last 3 years, about $2 billion, or let's say about 16,000 crores of total private credit AUM has been raised in India from Indian investors and deployed in India. So I think it is also a sign of maturing market as companies are becoming bigger, as companies are becoming more credit worthy. This type of capital is also being used by borrowers, and hence this is a play earlier that was available only to foreign banks or foreign funds. It is good to see that Indian investors are also able to get a pie of this capital structure. So this is the market perspective. Just very simply putting, what is private credit or what is performing credit? So private credit is a very broad term, and there are probably 3 or 4 buckets within that. As Vaibhav and Hardik mentioned earlier, look, it is a broader spectrum. You see a chart here where you have performing credit at about 20,000 crores in 2022, venture debt, and on the right you see distressed debt. All this is effectively private credit. And there is a subset of this which is also real estate credit. The reason I break it down is because we don't do real estate credit. Most of the other performing credit funds also do some bit of real estate. So now if you see from left to right, the venture debt is largely for, as the chart also says, it is for early stage businesses. Typically, these businesses will not have too much history. They will not have history of operations of maybe 3-4 years. They will not have history of EBITDA profitability or break even at this stage. And the exit for venture debt is effectively raise of next equity round by the company. So it's a very unique, different kind of product, wherein you are relying to some extent on the business and cash flows, but you are also taking a call that the business will actually be able to raise the next round of equity. So that is venture debt. On the other side, there is distressed debt. Distressed debt, I think we've all read and seen how the Indian banking sector has probably overlent to some corporates. A lot of it was misused, but a lot of it was also genuine cyclical trouble that companies had. And these companies with high levels of debt eventually need a correction, right? So this is where distressed funds come in. They resize the capital structure of a company and make the company viable so that the companies exist for the future. The return expectation for a distressed fund is just short of equity or very close to equity in that sense. So somewhere between 20 to 25% return is the expectation on a distress fund, versus on a venture debt fund, somewhere between 15 to 18% return is the expectation. In the middle lies performing credit. Performing credit is to companies which are broadly doing well, but need capital, we need debt capital, which banks cannot fulfill or NBFCs cannot fulfill. So effectively, what are the three types of risk that you take in performing credit? Very simply, you either take a little bit of higher credit risk, so which means you say that you deal with companies which are, let's say, double B or lower, something of that sort, or you are levering up the company more than 3 times EBITDA, right? Globally, people go all the way up to 6 times. In India, we don't do all this, but effectively, you are taking higher risk. So that is one type of risk private credit takes differentially. Second is duration risk, which is banks need an amortization structure and need an EMI type of structure, wherein the principal comes back over the time of the term of the loan. Banks have very straight-jacketed structures that, this is the structure and the company's requirement fits into that structure. Versus a private credit fund is happy to do like a 3-year bullet structure, is happy to match the cash flows of the company to the structure that they actually write. So they are happy to take a different customized duration risk versus a straight-jacket structure that a bank can put. And third is regulatory advantage. Banks are restricted from not doing certain things. So they cannot lend against shares. Hence, effectively, they cannot finance purchase of company shares. They cannot finance acquisitions if the acquisition is through purchase of shares of a company. So all these things that banks are restricted from doing, a private credit fund can actually underwrite and do. So I think from a broader perspective, it is the right thing for the regulator to actually restrict banks to only certain type of risk, because then they can grow to a much larger scale and they can raise money from depositors. Versus a private credit fund would actually underwrite the business a little bit better, take more risk, but monitor the risk much better, right? Effectively, this is from a risk perspective, effectively, if you cut it from a yield curve perspective, there is a market with a differential of every 3% difference in the yield. So up to, let's say, 8 to 10%, that is where banks operate. Somewhere between 10 to 13 is where NBFCs operate. 13 to 16 is where private credit funds operate. And 16 or let's say 18 above is where distress funds typically operate. That's if you cut it from a different perspective of yield curve. Yeah, so that's a little bit about private credit. Hardik, I'll pass it back to you.
No, thanks, Neeraj. I think thanks for explaining the landscape. That's quite comprehensive. Essentially, the premium or the incremental yield comes from either regulatory or arbitrage or structuring flexibility, or some of the end uses that banks are not allowed to fund. And of course, as you mentioned, there may be a little bit of incremental risk, but a comfortable risk which you monitor and then able to ensure that repayments are on track. So that's broadly where performing credit fits in. I was juggling through the slides just for the audience to sort of get a glimpse of what we were talking about in terms of growth or in terms of end uses. But taking up from there, as in any asset category, Neeraj, there will be more opportunities than what fits in a particular investment thesis or a framework, right? And I'm quite sure that you will have a framework and a thesis, basic hygiene factors that you look for when you are evaluating companies or assets. So, just for the benefit of the audience, would be great if we can dive deeper in terms of when there is an opportunity for an asset to be funded in the private credit space. What is it that you look for? What are the things that you evaluate?
Yeah, I'll first cover some of the softer aspects, and then I'll cover some of the more objective aspects. So the first one and the most important risk from a perspective in India is counterparty risk. I think there is no substitute for counterparty risk, The reality of the Indian legal system is that it is still extremely time consuming. Any solution for a lender could take very long. You can debate whether the Indian legal system is strong enough, not strong enough. But beyond the point, even if it's strong, even if it is strong, but if it doesn't resolve things quickly, the cost is to the lender and hence to the investor, right? So counterparty risk is the biggest risk, and intention of any counterparty is the biggest risk, right? And hence, to be able to understand the market, to be able to make sure that you've dealt with enough promoters, you've dealt with enough businesses, you've dealt with enough cycles is extremely important. So I think counterparty risk, there is no substitute for that, and that is a much more softer aspect rather than a tangible aspect to private credit investing. Second is, of course, business risk. I think the ability to underwrite a business, ability to see whether the business is sustainable, whether it is growing. Most of the businesses that we see are typically growing, but does it have then the right financial structure to finance that growth, right? So business risk is the second largest risk. The third is a cycle risk. About a third or maybe 30 to 40% of the total capital that goes into private credit is typically cyclical industries. So you see a lot of asset-heavy businesses like steel, manufacturing, etc. Right? So I think you have to be able to underwrite the cycle risk much better. Where in the cycle you are, let's say if you're doing a paper deal, paper prices are at the peak. But why are they at the peak? Because the largest capacity in the country has been shut down, right? So will it exist forever, not exist forever? So I think cycle risk is a different risk than, in my view, than just the business risk in the company. And fourth is execution risk, right? So not execution risk from a company perspective, but execution risk from a structure perspective. So is your structure implemented? Have you built in enough caveats, enough covenants to ensure that you can act quickly if required? And then are there avenues for the companies to stop your actions, right? So these are the softer aspects that you have to deal with in any situation, and that's how we think of every situation going in. That's how we present to IC that, look, are all these types of risks firstly mitigated? In fact, on something like counterparty risk, like each IC member forms their own independent view by doing their own independent check. So the investment team would do whatever they have to do, but and that's why the whole institutional framework of an IC, which credit funds follow, is actually very good, because there will be like 4 or 5 people who will look at every situation, will have a view on that individual, right? So that is actually a good thing for a private credit fund, because it operates through a proper investment committee format, right? Now, how do you on a softer aspect, how do you try and mitigate some of these risks, right? So firstly, alignment of interest with the promoter, right? Alignment of interest of funding growth. You don't see that alignment of interest when you're actually doing a distress investing, but you see that alignment of interest when you're doing performing credit, because the company is growing, you are funding the growth of the company, the business is making money, and the business is sharing part of that money with you, right? So I think alignment of interest with the company is very important. It takes care of some bit of counterparty risk, not fully. Second is size. I think one thing that we've realized over a period of time, size solves for a lot of issues, right? Across cycles, you didn't see it too much during COVID, but if you look at the credit squeeze during IL&FS and all the other credit squeezes before, smaller companies are just not able to find money during a credit squeeze. Now, whether it is not about the cost of that money, they're just not able to find money at all. And the money in India just gravitates only towards larger assets. So firstly, you need to have a size cutoff. For us, the size cutoff is somewhere between 75 to 100 crores of EBITDA. We haven't, even till date, we haven't touched a company that is 100 crores of EBITDA. Our smallest is right now 200. But we will do things which are at least 100 crores EBITDA. I think that is a good size in our view. And our view is that at that level, businesses start becoming stable across cycles. Third is structure and control, right? So whatever security you have, what is the real control you have over that security? Are you ring fenced with respect to other lenders? One other thing that we've learned is, if you have a lot of banks in the capital structure who are sharing your security, banks cannot move as fast as you, or NBFCs also cannot move as fast as you, right? So you as a lender, while you may have the right intent, you may underwrite everything well, but if something goes wrong, right, do you actually have control over the asset that is security for you? So that is very important. Fourth, risk and reward needs to match up, right? So I think, are we being true to our investors by pricing the risk in the right way, right? It's very easy to deploy capital by doing deals at 2% lesser than somebody else is doing, right? So I think that is very important. That risk and reward needs to stack up in every situation. These are more softer aspects. In terms of more tangible underwriting that any fund in private credit would do, there is, of course, the internal team which would have had experience to, underwrite business model of a company, financial model of a company. But you always get an additional check done from an external diligence agency. So typically, you will have one of the large accounting firms look at the business of the company, give you a diligence report, and then from a debt perspective, you check whether there is something, there are any hidden liabilities that you've actually not seen, and you check for sustainability of profitability of company. From a legal perspective, we typically get one of the legal firms to look at all the contracts of the company, any large legal liabilities, any tax liabilities which are unforeseen, any history of tax liabilities which could give you some sense of, is there any wrongdoing in the company? Simple things like, even matching GST numbers with sales of the company. These are very simple things to do, right? But they give you a lot of indicators and perspective into the company. The third thing is, our view is that keep asking questions. I think if you keep spending time with the company, speak to the competitors of the company, speak to peers. Every private credit fund, right, it's coming from a reputed house in some shape or form. And they will have touch points, which will be beyond the investing team, right? So use that. Speak to more and more people. I remember this one instance. We were looking at a company in Coimbatore. We didn't know them at all, and we were very, very worried that, look, we are not able to do it within the team. But we called up the bank RM in Coimbatore, and he actually knew the company very well. So he gave us a good check on the company. Second, he got us a call with a competitor in Coimbatore itself. And we were able to, and who was a client of ours. We had actually lent to that competitor. So we were able to have a very open conversation with that competitor. It's a closed door conversation, but you were able to do a lot more check on the business that you regularly do. And my view is that, look, if let's say right now we're doing a renewable business. Just last night we were discussing that, look, even if we are doing a simple deal in a renewable business, which is not very difficult to underwrite, PPA hai, asset hai, kar lo, right? But no, I still told the guys that, look, can we go and see at least a few sites on our own, right? Just if you spend time with the company, right, you realize, you speak to not only the promoter and the CFO, you speak to 5 people in the company, right? That really helps. So you do your own hygiene diligence of financial, legal, etc. But don't do any deal in a hurry. My view is that, like, don't do deals in like 3 days unless you know the people, unless you've done a deal with them in the past. Spend time with the company. That is most important. And the last and the most important thing is monitoring. I think there is no substitute for monitoring. I think underwriting is a part of it, but debt is not about deploying money. Deploying money is very simple, right? Getting money back is most important, right? So, and you have to be very clear that just because you've given money for 3 years, the company doesn't start treating it as equity. You ensure that the monitoring is extremely high through the process. You ensure that covenants, whenever they are breached, are there real reasons for that breach? What is the impact for us? Do we need to get out? Do we need to stay in? So I think there is no substitute for monitoring. You can underwrite as much as you want, but the reality is that nothing is static. Everything keeps changing every quarter. So there is no substitute to monitoring. From a go no go perspective for us, like when we look at a performing credit fund, right? We don't do VC debt, we don't do distress, right? So we ensure that we stick to the mandate of performing companies. I spoke about minimum size. So we don't go below 75 to 100 crores of EBITDA in terms of size of the company. Then there is an additional thing that we don't do, but there is no real logic to it, and most of the funds actually do it on the street. We don't do real estate out of this fund. Our general view is that, look, every family office or every individual who's investing in a fund like this has real estate exposure directly, right? So either they have hard real estate, or they've invested in a real estate fund, or they've invested in a REIT. Some or the other, every Indian has real estate exposure, right? So when you're doing performing credit, we want to ensure that we're trying to restrict it only to corporate debt and not commingle risk for an investor. But I don't think it is wrong, because I think in performing credit you also need to underwrite. You underwrite much deeper. So I think if there are funds that are doing real estate to some extent, like I think putting 10-20% of the fund towards real estate there is no problem. But that is something that we don't do.
Great, great. I think Neeraj, that's quite comprehensive. So essentially, we covered softer aspects, more tangible aspects. It's a very comprehensive way to underwrite a company, spend time with the company, talk to peers, talk to clients, understand from whatever access you may have, including a bank RM who can tell you about the competitor, and that forces you to have conversations elsewhere. These
Yeah.
are very prudent ways to sort of underwrite companies. One of the key takeaways for me personally from this was the fact that you mentioned that investment committees are now institutionalized in a
Yes.
way that even if the investment team would have underwritten something, it still goes through an investment committee which will have an independent view. And I'll take that opportunity to sort of get a few words from Weber. Weber, given that you've been on investment committees of family offices, I'm sure over the last 20 years you've seen multiple opportunities in debt, in private credit specifically, and have given your sign off or rejected transactions in this space. What's been your experience in terms of general go no go? If you want to add anything on how do you really evaluate and what sort of risk to actually play out and which you would want to avoid?
No, it's very interesting, and Neeraj covered most of the points, and these points are common across all investors, whether it's a fund that Neeraj is running or whether it's an investment decision which is taken by an investment committee at family office. So one of the first things that we always look at is the risk of repayment. If repayment is dependent on refinancing, then it's a fairly risky territory. And Neeraj spoke about venture debt. And the reason for which we have stayed away from venture debt is because your dependence on repayment is on further equity infusion. And that's where performing credit stands out, because operating cash flows of the companies are good enough to service your loan or make a repayment. The other thing which is important in lending is understanding business cycles. And they're also cyclical businesses. Their earnings may not always be stable. And therefore, we choose to stay away from real estate lending, because in real estate, cash flows can get delayed purely on account of regulatory issues also. When you are underwriting a risk, the first thing that you need to make sure is enforcement of security is not needed. It's good to have security, but you don't want to get to a point where you need to enforce the security, because in a country like India, there can be significant amount of delays even after the implementation of IPC. And I've seen it in the past, and some of the popular transactions, one of the largest infra lending companies which went through this bankruptcy process, even for the asset classes where specific collateralization was there, it took borrowers to 5 to 6 years to recover their loans. Therefore, it's important that you are not getting into a cyclical business. You're not doing a transaction where your repayment is dependent on the refinancing of the loan. And third, you don't want to get to a point where you need to liquidate the asset, because it's honestly there's an interesting saying in investing world. There is no reward for being optimistic in fixed income investing, because there is no upside, there can only be downside. So it's important that all these boxes are ticked, and your repayment is coming from operating cash flows. Lending is restricted to businesses which need money for growth, and where they can't access banking capital for that specific requirement.
Great, great, Vaibhav. So essentially, self-liquidating assets rather than event-based risk of equity or further debt infusion would sort of be one of the prime hygiene factors, and that's where this asset category is slightly different from venture debt or distressed in that manner. Of course, one of the
Yeah,
other
other thing, the cost of borrowing should not become a deterrent for the borrower to repay your money. Say, typically businesses generate 18 to 20% kind of ROEs. The moment business start borrowing at 20 plus rates, then they are compromising on their ROEs, and that can impede their ability to repay the loans.
No, and that actually goes back to the point that Neeraj also mentioned, that alignment of interest in this asset category is extremely high because business can generate that kind of ROE, can get to growth with this capital, which is not sort of significantly expensive. Vis-a-vis when we look at distress, of course, alignment may not be so high.
Yeah,
So
absolutely. Yeah.
all great points. I think I'm sure we've got deep insights in terms of how do we really evaluate assets, what are go no go zones. One of the other aspects, which briefly we've already covered, risks and mitigants. While at the time of evaluation and also at the time of monitoring, as Neeraj mentioned, that this is the business of actually collecting money back, not really disbursing money. Disbursing money is the easier part, but of course there are checks and balances at that place as well. Post that, we get into deeper monitoring, keep having conversations with the companies, keep evaluating both tangible and softer alignments so that we ensure that the money is paid back. Money is paid back. I'm hence slightly mindful of time and not spending too much time further on this aspect. Moving forward, Weber, this is a question to you, right? And you've been sort of guiding HNI's family offices on investment, capital allocation, etc. What is an investor's perspective? I've got capital to deploy. What should I be looking at? How should I evaluate this asset category? What are the prime reasons why I should think about allocating capital here?
So investors typically keep money in different compartments, and one of the compartments is where they are looking at predictable returns, and that's where this asset class fits in. Investors who are looking for recurring cash flows, because this asset class has an ability to generate recurring cash flows, where borrowers are paying interest at a preset frequency, and that income can keep accruing. Second, you want to lock in your fixed income returns for a slightly longer period of time. Uh, Short period of time, if you lock in money, your rate of returns would be significantly lower. Third thing, because of which I see significant demand for this asset class, especially amongst uh, individual investors, is changes in the tax regime. Pre-2023, it was easy because you had enough fixed income instruments which were available with preferred rate of tax. You could simply invest your money in fixed income mutual funds and get benefits of indexation and lower rate of tax. Or you could invest in market-linked debentures and pay 10% tax. So your post-tax yield was fairly attractive. Since all of these options are no longer available, this has created a vacuum for investors in fixed income investing. Inflation for most of us in the vicinity of 7 to 8%. So unless you are able to generate returns which are higher than that, you are actually losing your purchasing power. So that has created a lot of excitement amongst the investing community towards this asset class. Along with that, uh, mutual funds and wholesale NBFCs has vacated this space because they are not seeing significant flows of capital coming their way. So this pool of capital which was available through those sources needed a replacement. So from individual investors' perspective, it's a great time to invest in this asset class where you can generate 13 to 15% kind of returns, lock in your returns for a long period of time, and have recurring cash flows. The only uh, caveat to that is these instruments will come with much lower liquidity. Therefore, you need to be mindful that when you're investing money in this asset class, you have a time horizon of 3 to 4 years.
Great. And Neeraj, a little bit of feedback from you on this as well, given that you've raised large capital for this fund. What's the investor's perspective if you were to add anything to what Weber already mentioned?
No, I think Vaibhav summarized it extremely well. I think there is, of course, there is a lock-in when it comes to this kind of a product. So I think you have to be mindful of that. And actually, I think, when you think of whatever your debt equity mix may be, let's say 60-40 or whatever that mix may be, allocate a portion of this because everything doesn't need to be liquid, right? There will be a certain portion that will be liquid. Figure out what you are comfortable with, and that portion can go towards this kind of an investment. It's a good way to start actually experiencing this product also. As Weber also said in the beginning, look, it was a shame that this product effectively was not available earlier to Indian investors, right? And most of that money was being made by foreign investors or foreign banks. So I think it's a good outcome. The only way for investors to play this earlier was through NCDs or bonds by NBFCs, right? That was the only indirect way to actually play this. But that doesn't give you enough return, right? So this is a better way to access those deals directly, and I think a portion of the portfolio can definitely go towards this. Second, I think of the market, think of it from a market side also. Market is extremely volatile. It's expected to stay volatile. So even from that perspective, if you have a product which is continuously generating some return for you and paying out to you regularly, that also is a good way to look at it, because as Indians, our general philosophy is that market mein lagao ya real estate mein lagao, right? These are two avenues that we generally do. So this could be one more asset into that portfolio.
Great. I think I've listed some of the FAQs generally as feedback that we've got from clients in terms of what they want to understand. I think we've covered one or two, unless Weber, we want to add something in terms of how should investors evaluate portfolio fitment, and who should allocate money and what part of portfolio should they invest here. We can just spend a couple of minutes on these questions.
No, so I spoke about product fitments in your portfolio where you're expecting a recurring cash flow and you have money which is available for medium to long duration. Allocation should go in this asset class. Make sure that you diversify your investment across multiple instruments, because unlike in equity and fixed income, there is no penalty of over diversification because returns are predefined. So in equity, we always say that if you over diversify, your returns will go down because over diversification is return dilutive in case of equity. Whereas in case of fixed income, because returns are defined, even if you over diversify, there is no dilution of returns. So investors should look to over diversify in fixed income. Allocate money which you will not need for at least 3 to 4 years, and the way to participate in this asset class, and going back to my previous point of over diversification, there are two ways in which you can participate in this asset class. You can invest in funds which are available and you can select individual funds. So Neeraj also runs a large fund at Kotak. So similarly, there are multiple funds which are available in the market where investors can allocate money individually. Second, you have structures like fund of fund, and these are funds which will pool in money from investors and allocate money to multiple funds. So they essentially help you diversify your risk and evaluate funds within this category. So these are the two ways in which you can participate in this asset class. The best way is to go to the investors or fund managers who have done this underwriting in the past, because it's important that you understand the underwriting risk and the process of underwriting.
Great. I think that's about it from our end. There are a few questions that have come up. I see a couple of hands raised, guys. You can post your questions on the Q&A section. Archit, Prasad, if you all can post it, it'll be easier. I think we've already covered the part that we wanted to cover as part of the webinar. I leave the floor open for questions. I'll begin with some of the questions that are already posted. One of the questions that I've seen 3, 4 folks ask is there a credit rating for private credit? Neeraj, you may want to answer that. So there are 2, 3 questions that have come up. I'll just pull them all together. Do you insist on credit rating for this sort of borrowing? And generally, is there credit rating for private credit?
To answer the question very simply, probably not. First of all, there is no rating requirement, right? And none of the funds actually rate the fund. Do you insist on companies getting rated? We don't actually, because depends on what type of capital, what type of the capital you provide, what structure you provide. We don't insist on even the instrument getting rated. Having said that, we generally have seen that we operate in the A minus type, A minus to AA type of category as a house at least. That's where we generally try and make our money, and then you make the extra alpha from customized solution that you provide. I would say probably 60%, 70% of the companies that we lend to will have an underlying rating. Others will not. A lot of them will be private. There's one company that we just gave money to, which was an IT company, IT products company, not IT services, but IT products company, and we are a single lender to that company. The company has no need to do any rating.
Got it. One other question as an extension of the same question is, will a default by the borrower impact his credit rating?
Of course, if there is a credit rating in place, that directly goes to D, right? So that, of course, does impact.
Got it.
So not only, let me just add to that. Sorry, Hardik. It's not just default on either your loan or somebody else's, but there are generally cross default clauses across lenders. So if there is any default across the group somewhere, generally it triggers default in the whole group.
How does security collateral rank for this lending vis-a-vis existing bank borrowings? General questions around what's the security package.
Yeah. So as I said earlier, look, at least we generally don't like to see pari passu with banks. We generally like to see ring-fenced security. We generally like to see more control on our security. I would say about 70, currently I think the number is more than 70, but I think 70 to 75% of the portfolio for us should have control over the security or the company. In private companies, one of the big reasons we've lost a few good deals is we've asked for 51% pledge of the shares of the company also. Even if you are inside the company, we've lended for operating reasons. We ask for 51 to 100% pledge of the business. Just gives us more control. So generally, we have seen that we stay away from pari passu with banks. But there are certain deals that we've done, the market has done, where you are pari passu with other banks or other co-lenders along with you. General philosophy for us, at least, is that when you are pari passu with other co-lenders, try and be the bigger guy in that stack so you have better control also.
Yeah, just to add to what Neeraj said, specific collateral and general collateral are two ways in which you can securitize your debt. Typically, we prefer specific collateral. So, for example, if there is a borrower who owns a property, if you have charge over that property, even if he defaults, as long as your charge is specific, you will be able to recover your loans. And that's how we approach investing in this space.
Yeah.
Got it. There are some general questions around the minimum entry ticket to invest in such products, the tenor, the lock-in. Vaibhav, you may want to take the.
Yeah, so the minimum regulatory requirement to invest in private credit funds is 1 crore because these funds are operated through an alternative investment funds. So 1 crore is minimum. If you go to individual funds, you'll have to invest 1 crore in each of these funds. If you invest through a fund of fund structure, you can invest 1 crore in the fund, and that fund in turn will allocate money across multiple funds. So by investing 1 crore, you can have diversified exposure to multiple funds. The tenure is typically 4 to 5 years. And sorry, what was the third question? Lock-in. So lock-ins
Lock-in.
are there. So these funds are not liquid funds, so need to hold these funds till maturity. But there are periodic cash flows, both in terms of interest payouts and principal repayments.
Got it. So that covers questions around the funds. One of the questions is the investment category regulated by SEBI.
Yeah, this investment category is regulated by SEBI. These funds operate under the category 2 alternate investment funds, through which fund managers allocate money to various transactions.
Got it. There are questions around approximate returns that we can expect, and at what interval should we expect cash flows?
So typically, these funds operate within 13 to 18% range of returns. Neeraj can add to that. The one thing which investors should be mindful of is to consider the gross returns and the net returns. Different funds will have different fee structure. Some funds will have pure fixed fee. Some funds will have fixed fee with profit share, with catch up or without catch up. So it's important that we develop a good understanding of your net returns after accounting for the expenses, which will be charged by the fund manager.
Yeah, I'll just say about that very rightly, as you put it. I think net returns are most important for investors. And when you look at the expense, there are three parts of it. As Vaibhav put, there's a fixed charge, there's a carry, which is a profit share, and there is expenses of the fund. So I think when investors look at it, you have to look at the total charge that a fund is charging, assuming their promised return, right? Whatever total return they are estimating on a gross level, assume that, reduce all the charge, and look at your net return. We are promising about 16, and we are currently operating across the portfolio at 17 plus. The other aspect to think about is taxation for investors. So direct individual investors get taxed at their marginal tax rate, which is very high. But if you have an LLP structure or a company structure or a trust structure, it's a little bit more tax efficient from a debt perspective.
Got it. I think there are questions around fee and cost structure, which partly Neeraj, Vaibhav, you all have covered, that there is a management fee and there may be a carry and a hurdle. You want to elaborate further, or we can move on to the next set of questions?
I think we covered it.
Questions around taxation, we've already covered. For different categories of investors, what tax slabs are applicable? What are the types of funds available? I think we've already covered that as well as part of the webinar. The three subcategories we've covered. Of course, there could be more, as Neeraj mentioned. There could be real estate focused funds as well, which would be slightly different. How are private credit funds taxed, and how do they compare to other debt instruments returned post 2023 indexation amendment? That was that was part of the first slide that we covered on a gross return basis, and then depending on your tax slabs, you can compute what your net returns would be. But on a gross return basis, of course, these will give you significantly higher yields. One of the questions, Neeraj, that has come for you specifically is that we've been going through a credit upcycle and supportive growth environment.
Yes.
And generally, performing credit may also lend to cyclical businesses. What are the mitigants if the cycle starts to turn?
Yeah, very, very good question. I think it comes down to the point that Vaibhav and I both raised. That look, the reality is that most of the funds in the AIF category today raised for private credit are about 2 to 3 years old, right? They have not seen a full cycle. So I think maybe it's a biased view, but generally what we tell investors is, go with funds which have investment teams which are seasoned, which have done this business before, or with fund houses which have done this business before. Like for example, for us, we've run this business for 20 years, and we've thought that for 20 years it was not the right product to bring to an Indian investor, because it's a risk that an Indian investor needs to first appreciate and then invest, right? That's why the minimum for us is also not 1 crore. We've put it as 2 crores. right? So it's a starting point. We are also conservative in the way we are pitching it to investors. We don't want to sell it like a mutual fund. This is not a mutual fund because mutual fund has liquidity, right? So I think these are some of the aspects that you need to think about when you look at any fund. No fund manager is bad willing, right? Everybody means well. Everybody wants to do the right thing. I think it is experience, and as Vaibhav said, if you've done it before, it just helps.
Yeah.
Got it. Vaibhav, I think one of the question is how is this different from the fixed income strategy of Reserve?
So there are two differences in the fixed income strategy of Reserve. So we participate in the papers of NBFCs, and typically those papers will generate lower returns compared to this strategy. But liquidity in those instruments is much higher compared to this. So both of these instruments serve a different purpose in the client's portfolio. Investors who are looking to invest money for a short period of time should consider the fixed income strategy. And for investors with medium to long term allocation of debt money should consider private credit as an asset class.
Got it. There are questions around in what ways are investors safeguarded? Uh, what are the protections available to investors? Generally, any disclaimer, Neeraj, Vaibhav, for audience to be clear about how investor interest is protected?
So Neeraj covered that through the security package that he spoke about. Most of these transactions are secured against specific collateral, and as long as promoter's interest and your interest is aligned in terms of desire and willingness to protect the value of the security, there's enough protection which is available to the investors.
Yeah, I agree with what Vaibhav said. Just on the regulatory aspect, as earlier somebody asked, so we are this, again, it's a biased view, but we are this unique animal that is not just controlled by SEBI, but is also controlled by RBI because we are a 100% subsidiary of a bank.
Got it. I think there are more questions around that. I'm going to skip those. There's a specific question for you, Weber. What about perpetual debt instruments and kind of instruments dealt with? And what are the returns from AA rated bonds generally?
So, as most of our investors are aware that we don't look at ratings in isolation, so we look at other aspects of balance sheets and liquidity of the borrower. But double A rated papers would typically deliver returns in the range of 9 to 10%, whereas objective of this instrument is to generate 14 to 15% kind of returns.
Where I think we'll have time for two more questions. There are a host of other questions that have come up. I'm just going to sift through and see if there are any other unanswered questions. Again, Weber, for you, how can Deserve help customers invest in these funds? Does the PMS take care of it automatically, or the client has to give an explicit request?
So there is an explicit request. These funds are available on the private placement basis. So investors should reach out to their investment expert, and they should be able to guide them with the process.
Okay. For the benefit of everyone, I'll just post a link so that it's easy for them to know what are the next steps in case they are interested in this asset category. Moving on to the last couple of questions. I'm not sure of this. Maybe Neeraj, you may have to take this up. Does inclusion of Indian bonds and JP Morgan bonds index starting June have an effect on yields of performing credit as well? Overall, do you see this impacting overall bonds market?
Yeah, I'll take the second question first. So I think it's a great thing for the Indian market. I think the reality is that if you look at the markets, there are two large borrowers: the government and BFSI, right? Banks and financial services, right? They basically take away 75% of the liquidity that exists in the market, right? Whether institutional or retail or whatever, right? So I think you need, as the country is growing, you need a bond market to exist because banks are going to move more and more towards just regular flow business, right? So I think it's a great thing from a bond market development perspective. Private credit is, okay, let me say performing credit. Let me not say private credit, but let me say performing credit is something that operates generally between the 13 to 16% handle or 13 to 18% handle, as Vaibhav put earlier. And of course, it does get influenced by what are the yield curves in the market. But there is a range. It operates within that range, right? So, if the rates were 5.5% for GSEC like 3-4 years back, and today they're at 7.5, right? It doesn't move 40%, right? In private credit, rates don't move 40%. They operate within that band. They would, in a low yield environment, a deal that you would do at 14% would be a 15.5% deal in a high yield environment. So that's the band generally.
Got it. I think I'll take one last question before we wind up. Again, Weber, this is a question directed at you. This is like an AIF where entry ticket is 1 crore. What is your recommendation on somebody to start investing in this asset category who's already got 10 crore plus in equity? Better to invest in this class and diversify?
I think investors should look to diversify. This asset class is attractive, delivers high returns, but on specific amounts, it's honestly a very specific question, and clients' portfolio specific requirement should drive that decision.
Got it. I think that's about it. There are a series of other questions around naming some of the funds. How do we find and invest in such funds? What are the other types of funds available in this asset category? So on and so forth. I think given that we are time constrained now, we will wind this up. For any specific questions, you can reach out to us. You can reach out to your RM to answer any of the questions. Separately, I've shared a link where you can book a call and know more about this asset category and anything else that you may have questions on. With that, I'd like to wrap this up. Thank you so much, Vaibhav and Neeraj, for this deep dive into private credit. I think all of us go back with a much more deeper understanding of this asset class. We appreciate the opportunity and are much more confident of thinking through of our own portfolio allocation to this asset class. And I'd also like to thank the audience for sticking with us through this session, being very patient through the webinar, and then the kind of questions that we've got. We've, I think, answered most of those. With that, we would wind this up. That's it up from us. Thank you so much, guys.
Thanks a lot. Thanks, Neeraj. Thanks, Art.
Thank you very much.